Lawmakers in Washington have less than 2 weeks to craft legislation to raise the nation's debt ceiling. If they can't meet the October 18th deadline, the U.S. could default for the first time in its history. And that could have a rippling effect on the country's economy. News 3's Danny Valle joins us live in studio with more. And Danny, what kind of impacts could we see if that debt ceiling is not raised?
Well, Mark, if it doesn't happen, you can expect to pay more on loans. If you're looking to buy a new car or finance a home mortgage, those interest rates could climb higher. And one SIU economics professor tells me some of those rates are already increasing as the debt ceiling debate continues. And along with rising rates, we could see some government programs eliminated, according to SIU economics professor Kevin Sylvester. Now, at this point, Sylvester says it's tough to tell how much rates will increase or what programs will be axed. But he did say this: watch your savings bonds. Sylvester says the yield or the return on bonds starts skyrocketing when concerns grow on a possible default.
If bond yields stay low, maybe bounce around just a little bit, but not too much, it's an indication that at least the people who participate in the bond market think that what's happened in past instances will happen here.
Now, again, the debt ceiling is how much money the government can borrow. It's currently around $28 trillion. Now, Sylvester does believe lawmakers will reach a deal before the deadline. Now, the last time the U.S. voted to raise the debt ceiling was 2011. Since then, they voted to suspend temporary suspensions of the debt limit, the latest which ended in July. Now, in a letter to Congress earlier this month, Treasury Secretary Janet Yellen said it's uncertain whether we could continue to meet all the nation's commitments after October 18th.